Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
As nice as New Zealand was, I'm back.
Well, and
You thought you got rid of me.
Well, I was starting to feel like it was the breakup of Martin and Lewis or something. I mean, it was just over. Batman and Robin, or Bobby and Jack. I mean, it was just disturbing. It was
Paul and John.
Yeah, and then you showed up. Thank you for being more contemporary. Then you showed up. We saw you last Saturday. Don
but that
sighting
really
in
didn't
Everett.
count.
No, it doesn't, because this is the show.
Yeah, that really wasn't the show. That was retire meet.
Which was fun, by the way. Yeah.
This is the show. The show about money. The only show about money you ought to be listening to, really, because I've listened to the other ones, and they're not as good. 855
You say that rather unequivocally. Let me give the number because I got good at it while you were gone.
You want to give them? You remember the number?
No, I don't. I had to write it down. 855-935-8255. And yes, that's a toll-free number. Yeah, thank you. 855-935-8255 or talk. Yeah, okay.
TALK.
I have no idea how to do that on my phone. But we're glad to have you back. I know you had a spectacular trip.
You have an iPhone, too.
Yeah,
a quick lesson.
No, I have an iPhone 6 or something. I think it is.
Yeah, but go to the keypad.
I can see it on there. Yes, I can.
Yeah, and underneath each number, there are 3 letters.
Don't make me do it.
8255. Look at that. TALK.
Quit messing around and tell us about your trip.
Oh, my trip. Gosh, New Zealand is beautiful. Really, really gorgeous. Beautiful country. Got to tell you, got my upgrades to Delta One, which saved me because I look back in the back of the plane.
It wasn't good.
It didn't look comfortable.
Yeah.
My lay
like
flat
a 9-day flight or whatever it is down there. Or whatever.
I got it. My lay flat bed. Delta even gives you a pair of pajamas.
Wow. That's service. That's service.
I'm telling you.
Yeah.
Okay. Pair of pajamas, some slippers. Oh. And you remember I talked about Emirates and how I wanted to go upstairs and see the second floor of the A380?
Right, yeah.
Yeah.
You and 900 of your closest friends flying somewhere on the 380?
It's only like 6.
Okay, it's a lot of people. Wow.
But I
start loading now. You get there in July or something. How do they do that?
I got a note from Emirates that said the purser will come get you during the flight and take you upstairs.
Wow.
And I thought this will be nice. I get to tour it because it's like more expensive seats.
Yeah.
We checked in at Christchurch for our flight to Sydney on Emirates, and they handed me tickets. And they said I heard something about business, and I looked at Debbie. I said, "Did he say business class?" Looked down at the tickets. The tickets they upgraded us to business class, which is upstairs.
Just because you asked.
Just because I asked.
Wow.
Yeah.
Wow.
Well, I think maybe they checked and found out I was on the radio.
Oh, come on. Wow. I'm going to try that next time then.
Yeah.
Hey, I was on the radio.
I got to tell you, wow. Whoa, it's like a finely tuned machine up there. Those Emirates flight attendants, it's like, have you ever been to a really fancy restaurant where they do like the
scrape up all the stuff on your table?
You get like 3 people coming in and with various things, and it's orchestrated.
I have that at home every night for my meal, but okay.
Yeah, but that's because you do it for your wife.
I see. Got it figured out.
But they had this system where they were just like the meals were served on time, and a greatest bar in the back of the plane. A bar with get this, they have the seats at the bar with seat belts.
Well, it makes sense. You're on a plane. Plus, if you're drinking a lot at the bar,
you might not
don't
fall
off. Could have used that seatbelt a long time ago, but okay.
Really nice airline. It was a great trip. A totally beautiful trip, just from every aspect. The flying was good, considering it was 15 hours, from L.A. to Sydney. And the country, we drove it in a camper, which was really kind of cool. Yeah, if you long for the 1960s, you're an older one like us, and you long for driving America in the 1960s,
not like us,
on 2-lane roads, you're 60.
Barely.
I know.
Barely.
If you want to experience the old style road trip where there are no superhighways, go to New Zealand.
Okay.
There are no superhighways to speak of.
And you don't mind driving on the wrong side of the road. Woo.
I got used to that surprisingly quickly.
I haven't done that in 40 years, and I swore after that I would never do it again.
I got to tell you, it's the one-lane bridges that freaked my wife out.
Yeesh.
The one-lane bridges. Lots of those. 855-935-TALK is the number. From here on in, we're talking about money and how it affects your future, your bottom line. Money, and more money.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
For your real life and real future, Tom and Don are talking real money.
Managing money, investing money, is far less complicated than it appears, at least with most of the firms out there. Investing is far easier than you think it is, and we're here to help you do it better. So give us a call at 855-935-TALK, 855-935-8255. It's absolutely free. There is no obligation. We're not going to try and sell you anything, but we are going to try and help, as we've been doing for, I don't know, how many years now?
Lots of years. Try not to add it all up. And many of you are running around today. It's the nicest day of the year in Seattle, by far. And you're running around today picking stuff up to plant in your garden. So we're going to give you tips on saving money when purchasing seeds and starts for your garden. That's coming up.
It is?
I'll make something up. Yeah, okay.
I didn't even see that on the potential topics for the show.
I know. I'm having a little fun there.
What did you work? Did you work a deal with that gardening place in Maltby down the street from your house?
I love those guys. That thing is bigger than you could get lost in there for days. They have so many plants. Should I mention them? Give them the free plug.
What's the name of the place?
Flower World.
Flower World. Is it like an amusement park? Maybe they should put rides in.
They could. Hey. Well, they got stuff to pull your plants around. They can put them on a track.
Little high speed carts. What are those things called? What are those called? Those little 4-track machines?
I don't know. So
mules.
There you go.
Mules.
You gave the number. We're here to help.
I did. 855-935-TALK.
One of the this is so tough.
What?
Well, because you may have heard of the missile gap, right? You remember the missile gap?
Wow.
Okay. You may have heard of the credibility gap.
Okay.
Yeah, you know that one because a lot of things come out in there. That's all their story.
Or the current sensibility gap in Washington.
That's true. But do you know about the return gap? How do you like
there was
that?
an article in the Wall Street Journal about that recently. Mm-hmm. Was it the Journal? I think it was the Journal.
No, I don't think it was.
Yeah, a professor at George Mason University calculated and this is something you can find on your own at Morningstar, by the way. The return gap is the difference between what a mutual fund makes internally and what investors on average tend to make based on their buy and sell decisions. The inflow and outflow of cash goes into determining what an investor return is, and Morningstar actually has this number for every mutual fund they follow. You can go to the performance section. You type in your favorite mutual fund,
or
the
fund you're in. You're in a 401k. Use those.
The fund you're in. You go check it.
Yeah.
You go to performance, and it'll say investor return. Mm-hmm. Click on investor return, and you'll see the difference between what the fund makes and what the investor makes.
It's a fascinating thing. I mean, and most of this, frankly, is on us, right? I've met the enemy, and the enemy is us, because it does revolve around behavior, sadly. I mean, people have a tendency to...
it's totally behavior.
People have a tendency to buy what's been hot lately, and yes, we'll get to Bitcoin today. Don't worry.
Oh, yeah. I got a Bitcoin update for you.
I know you do. They tend to do that. They tend to do what feels good at the moment. Sometimes it feels good to buy stock mutual funds, and sometimes feels good to sell them because it's way down. I got to get my money out, right?
Right.
And then the third part is people have a tendency to hear something, think I got to do this, or they have a neighbor, they have a friend, they have a coworker that says you really should have some of your money in that fund, and they sell another fund and they buy a different fund. And that really is at the crux of this return gap. Why you as investors make less than the fund, but you actually did some of your own work.
I did. Now let me tell you, the professor.
I'm going to call you the professor because it's good work.
He went and just looked at all the funds out there, and he found out of all the equity funds that the investor gap averaged around 2%. So let's say the average fund made 7%. That after the investor gap, it made a little over 5%,
which is a huge. People are going to say 2% doesn't sound like much. 2% a year, folks. A year. That is a huge number.
It's a gigantic number. I mean, imagine if you were paying that much in fees to someone. You'd probably feel pretty bad about it. So anyway, what I decided to do was go take a look at 3 different mutual funds. One is a broker sold fund. Let me just pull up the numbers here because they
got them right in front of me.
I know you have them, and I don't know why I
print
don't
stuff
have
out
them.
on paper sometimes.
Oh, okay. Here we go. The Putnam Global Equity Fund, which is a broker sold fund.
Right. So you're paying a commission.
A shares.
Yep.
5.75% commission. The 10-year investor gap was 3.43%.
That's the difference between what the fund made and what people who own the fund made. Right?
Right.
Okay.
And that, the return over 10 years for the Putnam Global Equity A was 5.17%. The average investor, though, made 1.74%. Part of that is fees. It doesn't include commissions, but it does include fees. Then I looked at a very
By the way, the fee there, 1.12% per year, which is a pretty spendy equity fund. But then you're going to say, well, a global fund costs more. And I'm going to say you may be paying too much. Go ahead.
Not necessarily.
Yeah.
Then I looked at a very well-known no-load fund, actively managed again, from T. Rowe Price, the T. Rowe Price Global Stock Fund. Over that 10-year period, it averaged 5.8% per year, but the average investor return was 2.32%. That's a difference of negative 3.5%, 3.48%. A year.
That's shocking.
With an 0.8% expense ratio.
Which is, not too far out of line again for a global fund. Not too far.
Then I compared it to a very similar portfolio fund, the DFA, Dimensional Funds Global Equity Fund, which is only available through select investment advisors. You can't go get it on your own.
Yep.
One of the reasons why its investor gap is so good is because you are not allowed to play your emotional games with DFA funds. You can't play with them. You're not allowed to play with them. You can't go out and buy them and sell them on your own when the mood strikes you. Now, the average annual return for the DFA Global Equity Fund was 7.06%. A big part of that, though, is because their fees are so low at 0.3%.
Inexpensive fund, good returns, but here's the part that might surprise you. Surprised me when I saw the number.
Now, this is from Morningstar. I did not make this up. I did not get it from
This is not part of the credibility gap we referred to earlier, no.
According to Morningstar, the average annual investor return for the DFA Global Equity Fund is 8.23%, or was over the 10 years ending 5/9. This is from Morningstar. A difference of positive 1.17% per year.
So this is always the head scratcher because you're listening.
I know. I do it every time I do this.
More than the fund. So it either has to be regular investing, your dollar cost averaging into it, right? You're getting different prices because this is not a fund that you would be selling to rebalance because it's one fund that owns the entire globe, basically.
Right.
I mean, people might be selling this and buying a bond fund, I guess, maybe.
Oh, and just to verify it,
Wow.
I checked their other similar fund, the World Core Equity Fund, and its gap was a positive 1.12%, so almost identical.
Good behavior.
Two slightly different funds. Good behavior.
Yep.
Good behavior is rewarded with higher returns.
Tom and Don are talking real money.
If you need help allocating your retirement plan at work, you can get free help at 401-411.com. That's 401-411.com.
Your guides to a really great financial future. Tom and Don are talking real money.
So how smart are your investments? Are you investing properly? Give us a call, 855-935-TALK, 855-935-8255. And boy, Tom, you sent me this. Speaking of bad investments, an article in the Seattle Times
Great
about the
enterprising
Seattle
piece. Yeah, I think this is a wonderful piece.
The Seattle City Employees Retirement System, or SERS, over the past 10 years, made a whopping, this is terrible, 4.1% per year, leaving them short of the money needed to pay their obligations. And their administrator at the time, Jeff Davis, said, "I do not deny there were poor investments made. If there's something we should have done differently in the past 5 years, I'm really not clear on what that is." The dimensional fund we just mentioned, maybe, Jeff?
This is a shocking story at many levels. I tell you, you really want to know about this business, how bad this business really is, you read this story because it's got shady characters, it's got subterfuge, it's got apparently conflicts of interest in it where the person making the decision may have had a conflict of interest with the people that were helping the fund. And here's the part that's tragic. The fund that is going to finance people's retirement is $1 billion short. $1 billion short. So what happens? Well,
that's an astonishing number for one city's pension plan. One city.
So what has to happen is the city has to find the money from utility rates or head tax, whatever. I don't want to go there. Whatever they got to do, they got to come up with. They got to come up with the money.
You're just trying to scratch that wound, aren't you? You're just going to open it right up.
Is it shocking that they perform worse than that they were in the lowest? Well, I'll put it another way. 97% of other large pensions did better. Would you want to be in the lower third one? Not third, lower 3%? I don't think so.
Here's the thing, though. Part of it is because these folks think they're special, that they have special talents and are entitled to special investments. As a matter of fact, folks, if you go read the Seattle Times, Tom chimed in.
Oh, I did.
Online,
I couldn't help myself. Could not help myself.
And basically said, well, why, he didn't say these exact words, but why didn't he go invest just in this DFA global equity portfolio that, by the way, had an investor return of 8.23% per year over what they would have needed to break even?
And was told what?
You were told.
Yeah, no, that you can't do that. That would be non-compliant. That would be too risky to just be in public markets or index funds.
Wait, just be in the economy of the world?
Yeah,
that's too risky.
No, actually, that's a fine point because what he is saying, by the way, the person who responded to me is that just being in public markets is not investing in all the companies around the world because you can't in the public markets invest in our companies, right? They're not publicly traded. That's private equity, right?
You can invest in similar companies that do similar things.
Well, that's a good point, by the way. Number two.
Yeah.
Do you think it's riskier? Is it riskier to just be in public companies where you know the value of those companies every day, where you can get your money the next day, where the costs of moving in and out of those are far less? Or conversely, is it riskier to be in privately held companies, venture capital, timberlands, where you don't know what it's worth every day? It's horribly expensive to get into those investments, and you can't get your money back for long periods of time, in some cases over a decade. Now, you tell me which one is riskier. I know what I believe.
Public companies. And the thing, here's why I find this gentleman's quotation so ironic. He goes, if there's something we should have done differently in the past 5 years, I'm not clear what it is. Now, the SIRS counted on earning 7.5% a year to meet their obligations. Had they invested in a globally diversified portfolio of equities, which we both consider to be far less risky than all of these private investments and these complex, expensive hedge funds, they would have made exactly what they needed to make to meet their obligations. So, are you telling me there's not a simple answer? You're full of baloney. You just don't want to do it because you can't justify your expenses.
Tom and Don are talking real money.
We mention 855-935-TALK, 855-935-8255 throughout the podcast. But you need to know that you can call that number 24 hours a day, 7 days a week. Leave your question, and those will be answered in special Talking Real Money podcasts that will appear on this particular site in the future. So give us a call, 855-935-TALK, 855-935-8255.
Reality radio for a really great future. We're talking real money.
Help is at hand. We have the answers to most of the questions you need to ask about your financial present, past, even, and future. We don't predict the future, but we can help you enjoy a better one by calling 855-935-TALK, 855-935-8255. And Tom, you know what really, the business of the investor gap, people trying to get higher returns and failing miserably, the whole pension problem with Seattle and all of these other things.
Not just Seattle, it's huge.
But it really has to do with magical thinking. It's this belief that so many individual investors have, that cities like Seattle have, that they can magically get more than is realistic, that they are owed or deserve a higher return, like the sports figures who get into these Ponzi schemes because they think they're special and that they deserve a higher return. This thinking that they could get 7.5% consistently, which was what they needed, and pay people all the money they paid them, which when you look at the expenses, it would have required making a gross of 9% or more to get the 7.5%, and that's just untenable. And so many of these pension plans and endowments are in this same boat, and they don't get out of it because they don't want to stop feathering their own darn nests.
Well, I think that just the system rolls on, because another piece along these lines. So when you compare Carthage College to Harvard,
I don't even know what a Carthage College is.
Exactly. I mean, I don't know that you do.
I'm going to look them up.
Kind of a small place in Kenosha, Wisconsin.
Oh, of course, in Kenosha.
I don't think there's a lot of people that are considering, well, should I go to Harvard or should I go to Carthage?
Carthage.
Because
Carthage
I don't know that it quite
College
has the same, emphasis if you graduate from Carthage College. No offense to those of you who are.
It's cheaper. It's only it's not a lot cheaper.
Really?
The tuition and fees are $37,000 a year.
Yeah.
So
that's private school. But here's the part that I find fascinating. Harvard spent 4 years. Harvard spent $242 million to pay 11 investment managers to work their endowment and make the big money, right? And you know what happened, because Don and I know, they were searching out the very best hedge funds. They were finding the venture capital deals that they had to have. They went into timberland because that was all about where the money was going to be made, not those boring publicly traded companies that we mentioned earlier. So how did all that turn out? I just find this fascinating. Harvard made 4.4% a year, 4.4% a year for 10 years ending June 30th of last year, while Carthage College, their endowment made 6.2%. Guess what Carthage uses? Vanguard Index Mutual Funds. They don't get any of the special deals. They don't try to search out the very best managers, and we ran the number. I find this fascinating. The $242 million that paid those top 11 managers, that would have put 600 kids through 4 years of, it's still pretty expensive, by the way, through 4 years of education, housing, meals, and everything at Harvard, instead of spending that money to get a lower return than you just got being in publicly traded companies. You don't need to be special, as you said at the beginning of this, to make a good amount on your money. That, to me, is the message.
Well, and the other message is that, wow, these famous alum from Carthage.
Pardon me.
We got Laura Kepler. She was the, she was, right?
Not familiar. I'm sorry, Laura.
Miss America 2012.
Okay, I guess I should have known.
Alden Tom Clausen. Not the pickle guy.
Yeah, I
no.
don't know him either.
President of the World Bank from 81 to 86.
I should have known that, I guess, yeah.
I'm telling you, and wait a minute.
Yeah.
Now, this one you should know.
Uh-oh.
Rich Care.
The Rich Do Care or Rich Care?
No, Rich Care, Kehr. He played lineman for the Washington Redskins.
Oh, okay. Well, I don't know every person in the National Football League.
I knew.
Come on.
That was obscure. Every one of them was, well, wait, there's another one. Steve Jodat. Wait, you should know him. He played for the Seattle Seahawks.
Oh, pardon me. When was that? When?
And the L.A. Rams, let's see. Well, he was born in 1954, so
a long
it would have been a while
ago. So they don't have like a huge list of famous alumni, really.
No, I wonder how the size of their endowment compares to the $37 billion in Harvard.
It's in here somewhere, I'm sure. It's relatively small. But these are the kind of things you need to pay attention to, because you don't need to be special. You can use low-cost index funds and tune everything else out, not us, but everything else, and still do just fine, of course.
It's just so much easier, and as we will continue to show you over and over again, the odds are definitely on your side if you do it this way. Give us a call.
Tom and Don are talking real money.
If you're looking for a nice short podcast to tide you over between episodes of Talking Real Money, check out Money 30. Money 30 podcasts are between 2 and 4 minutes long, and they're available at every major podcast service, including Apple Podcasts, or you can visit money30.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, you know that Carthage College Endowment Fund at $107 million is much smaller than Harvard's at $37 billion. But something really interesting that I found, Bill Apt, the guy who runs it, puts the money into
him. Yep.
He puts the money into 10 Vanguard funds.
Ooh, that's crazy. Index funds? Come on.
The average expense ratio is 0.11%. That's his average cost.
He makes like a couple $100,000 a year. I mean, he's not.
Yeah. But
like
here's
those $242 million.
If Harvard did something similar and paid the same amount, 0.11% per year, they could probably get a deal and pay less than that even.
Absolutely.
But let's just assume they pay that. If they had paid that, reducing their investment costs, not even talking about the increased return, just reducing their investment costs, that would have reduced their investment costs by $200 million a year.
A year?
I'm sorry, $200 million over the
10
4 years.
Oh, 4 the
2010,
2014.
Yes. I mean,
that they were talking about the cost.
Just reducing your. This is one of the messages we try to get across is if you just reduce your cost of investing, you increase your return. You don't even have to do anything special. Just pay less.
Most of us don't know. Most of you don't know what you're paying.
No.
We see it almost every time when people come. I had one of the greatest meetings I've had in a long time this morning. A guy who's just worked his he was out working physical labor since age 11. He's retiring in his mid-60s. Been phenomenal. And he brought his daughter with him because his daughter kind of keeps track of all this. It was a wonderful conversation. And she's in a retirement plan of a very large company here in the area. I don't want to say which, and they offer both index funds and they offer actively managed funds, right? And so she was in an actively managed fund that charges about 0.8% a year, or she could conversely own the shares of the Vanguard fund for about 1/3 of 1%. She's in her mid-30s. I was trying to explain that over 20 years or 30 years, the difference of that savings would be humongous in her return. Just take it and move it from the active fund to the passive Vanguard fund. Huge savings.
Particularly when there is absolutely no academic evidence, empirical data that supports the notion that active mutual fund managers provide anything of value for the extra money that you pay. There is no evidence whatsoever. None. I mean, you go to Standard & Poor's, they do their Standard & Poor's index versus active survey all year long, and consistently active managers dramatically underperform. And then you have multiple studies that have been done S&P studies don't take into account just luck.
Right.
If
you could have picked Amazon in 1998. That's all you needed to do.
And that didn't make you smart. It just made you lucky.
That's right. You picked them over
so there have been
pets.com.
two major studies done where they actually mathematically removed the random factor, the luck factor. And in both of those studies, they found that the number of managers outperforming their benchmarks dropped from, in some cases, the best scenarios I've seen from S&P are 30, 40, 50% maybe in a couple of years.
Wow.
Dropped it from those numbers down to 0.6 to maybe 2% of all active mutual fund managers outperforming their benchmarks. That means that worst case scenario, you have a 99.4% chance of paying more and getting less from an actively managed mutual fund. Those are terrible odds, folks.
Yeah, those are pretty long. You want to join the conversation? 855-935-TALK, 855-935-8255.
I'm not used to you giving your phone number.
I've taken a lot more control since you were out of town. I stepped right in. Boom.
Out of town? I was out of the hemisphere.
You were way out of here. You're like a 9-day flight.
That's a long way away. But
you
know what's curious about the world? It all looks pretty much the same.
Really?
New Zealand just looked like a really nice version of the Pacific Northwest, kind of.
Okay, wait a minute. Whoa, I'm going to stop you. More sheep.
With more sheep.
But it doesn't look any nicer. I mean, things can't look any nicer than the Pacific Northwest. What would you do nicer?
Oh, I don't know. The West Coast. It's like they got those fjords.
Okay.
Lots of nice fjords.
Fjords. You
don't got any fjords.
That's true. Yeah.
And
but we got mountains and we got rivers and we got oceans and we got a lot of green. I mean, it's incredible how green everything is right now.
You don't have Jurassic plants.
No, that's true. We do not.
That was the weirdest thing, is driving through some of the pristine original forests that they've protected, and it's like you feel like you're driving into those pictures that they are a natural history museum where they have the exhibits of dinosaurs in their old natural habitat. They have these gigantic ferny things, like from the pictures of the dinosaurs roaming the earth.
Are you going to go see the new Jurassic Park this summer?
I don't know.
No. Okay.
I've turned into a person, and I
You've turned into a person. This is good to know.
No, I've turned into one of those people who says, do I really want to go to the theater?
Yeah, no, that's interesting. I will only go to but that's a big screen kind of picture.
Yeah, but now that I've got my 70-inch TV that's 4K
you're
in the
never
house,
going to leave and you can do the show
with
from
a
your
stereo,
house. And you're never leaving.
Why would I get in the car and drive down there?
I know.
Particularly with MoviePass about to go bankrupt on me.
It's a little different experience. You got to be honest. I mean, a movie like that is different in the movie theater than it is even on your 70-inch television.
As long as it gets good reviews. If it gets terrible reviews, I'm not going even for the spectacle.
We're going to go to a call very quickly.
We are?
Yeah.
Do we have
right
time?
Now. We have time.
Okay, we better hurry.
Bob joins us.
Hi, Bob. What's up?
Hi.
Go ahead.
How you doing?
Good.
Hey, so I've been having a managed account for I don't know, since 2009, and we have a trust, and then we have our own individual. I've since retired 2017, 50 years old, and actually 2017.
Wow. Hey, Bob, we have such a terrible connection. And plus, we're coming up on a break in just about 1 minute. Can we get back in touch with you in the next hour and see if we can get a better connection? Because it's really, really, really hard to hear the question, and we do want to answer it and spend more time with you, too. So we're going to try and get you back on in the next hour of the show. And that means for those of you listening to the podcast, if you want to hear the rest of Bob's question, you're going to need to listen to the second hour of the podcast.
Oh, man, that is hard to do. Okay.
I know. And for the rest of you, our number is 855-935-TALK, 855-935-8255. You can call us at that number almost any time. And what we want to do, our main goal, is to try to help you get the financial part of your life under control to the extent that you are able, so that you can have that future. Because the biggest thing you do with your money, the biggest thing you can do with your money is the saving and investing of it for
saving, number
that
one.
future.
Yep.
Save,
Yep.
invest, better future. If you don't save, you don't invest, you're almost guaranteed a pretty bad future. It's at least, at the best case, you're just going to survive. You're certainly not going to thrive. So give us a call, 855-935-TALK, 855-935-8255.
Tom and Don are talking real money.
If you're sick of investing through an insurance agent or a stockbroker and you're in the market for a fee-only advisor who charges truly low fees and uses a scientific approach to building portfolios for your risk tolerance and need, you should check out Vestory. Tom and I started this firm, and it is devoted to educating everyone, total transparency, clarity, low fees, and great service. If you're looking for an advisor, you ought to at least take a look at us at Vestory.com. That's Vestory.com. Or give us a call, 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
And Tom and I have been financial broadcasters and journalists for a very, very long time. And we decided several years ago that there was a huge need for an investment advisory firm that acted like what we believe, that taught people how to manage money and managed it in a responsible way. That's why we started Vestory. And if you'd like to talk with us, give us a call at 800-386-3004.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.